Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul examine research that tries to quantify the value of financial advice. High client retention rates imply that clients are happy. But how do you measure the value of advice? Past studies may have overstated the behavior gap, but recent studies provide additional insights beyond the singular metric. So don't forget about asset allocation, rebalancing, asset location, and tax-efficient investing. And beyond investing, perhaps it's the benefits from sound financial planning that make the biggest impact on happiness and well-being. And now, on to our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. Last week, towards the end of our conversation, we mentioned that some of the benefits you get from financial independence, that was like those intangible lifestyle benefits, could also be achieved by knowing you're on track, that you don't have to be financially independent to get those various lifestyle benefits. And as an observation that we had made of, as financial advisors, the clients we work with tend to exhibit those benefits. That sometimes just the idea of working with an advisor, knowing you're on track to achieve all the lifestyle components and achieve financial independence, gives you those kind of softer well-being, happiness, and lifestyle components, even if you haven't actually achieved financial independence yet. And after our conversation, Trishul and I were kind of thinking, we do see this play out pretty well, that clients who hire us, there's usually some acute problem. It's going to be taxes, investment, savings, something that they need help with. But ongoing, clients tend to like working with advisors for the various intangible benefits the advisor can provide to their lifestyle. And we see this when you look at industry studies, especially related to client retention rates, where kind of almost independent of why the client hired an advisor, retention rates of kind of signing up again with that advisor, keep paying them to keep working with them, tend to be in the high 90%, sometimes as high as like 97 to 99%. If we try to go across all advisors, the definition gets weird, but it's still gonna be pretty high percentage. And this implies that clients are happy with advisors and the benefits they receive, even if they are intangible. And so today, whenever I kind of hear that, I'm sure Trishul is similar, like there's all these intangible benefits and it's worth the cost and worth the fees. Like, I'm immediately starting to question it. Like, can we explore that, and like just not accepting at face value that advisors are worth their fees because of the intangible benefits, but actually exploring the methodology and looking at studies that have tried to quantify the value of a financial advisor. Kind of, is an advisor worth the fees that they cost? And so today we're going to kind of talk about that the methodology side, like looking at some studies, because there have been studies on what is the value of an advisor. Some of them may be flawed. Some of them might be only focusing on the quantifiable tangible benefits. And we're going to try to relate that to the intangible benefits. So kind of our premise is high retention rates imply clients are happy with their advisor once they sign on. But today we're going to try to examine not taking that alone as the sign that advisors are worth their costs. So one of the kind of classic things that has come up is this idea of a behavior gap, that You know what, Trisha, why don't you explain kind of like the idea of a behavior gap and how that was one of the first ways to think about the intangible benefits, so like what may have been immeasurable in the past uh, has been tried to be measured. When we look at that behavior gap of clients or investors that did not have an advisor versus investors that do have an advisor.
Right. The notion is that at a high level, there's a certain amount of returns that investments provide. And this level of return is something that you would hope to get if you are an investor. So the behavior gap is the notion that when investors actually go out to invest in these investments, they end up doing worse somehow, right? It's strange. Where does this extra underperformance go, and how is it quantified? So that's all the questions surrounding it. But the high level notion of this behavior gap is there could be behavioral things that investors are doing such that they don't attain the full potential of the returns that are generated by the investments themselves.
Do you have some examples?
Yeah, so there have been a handful of examples that have kind of get thrown around here and there, and I think we've even talked about a few over time. So at a high level, one thing that we've seen before is a set of research we talked about, I think quite recently. It may have been just a few weeks ago. This was how investors tend to chase performance. So in this particular study, using Morningstar data, what they did is they looked at the return, for example, that you should be getting on a balanced index or from a balanced manager. So if the return is X, and then you look at the actual returns of the investors who invest in just that, you would think it would be X, but it turns out to be X minus 1/3%. Now, how is it possible when an investor goes to invest in X, they don't get X? Well, it could be that they're just investing in X at the worst time, meaning they're making decisions that are working against them. And the study looked at various other markets and noticed this pattern time and again across every market it looked at. So it looked at international equity, US equity, commodities, alternatives, which is like more fancy types of investing, different sectors, emerging markets, and so on. And time and again, the investors who tried to obtain the return that these investments provide just did less than whatever those investments ended up providing. And it's linked to behavior, not directly, but in terms of a causality, but there's a correlation here where the more exotic an asset class is, the more likely that the investors ended up doing worse than the investments. So it kind of doesn't provide conclusive evidence, but provides this kind of correlative evidence that, yeah, these exotic markets might be more enticing and pulling people, from one thing to another, causing this drag in performance, this behavioral gap. So, for example, with these more exotic items like emerging bond markets, the actual underperformance for the investors from the actual investment is close to 3% a year. And, high yield bond, it's close to 2% or slightly over 2%. So you can see from just this one particular study that there is this notion that this fuzziness of behavioral gap might be able to be quantified from this perspective.
I remember when I was my first few years in the industry, there was the Dalbar study was probably one of the more famous ones that actually tried to quantify this. They looked at things like what you're talking about with the mutual funds. They can actually look at fund flows. So the mutual fund has to track its own performance over the entirety of the mutual fund. But like you said, they can see when investors are putting dollars in versus when they're taking dollars out. And it does feel like they're chasing returns. That the mutual fund goes up and maybe has some outperformance in a shorter time period. More money goes into that fund, and then the overall fund itself kind of has an underperformance, so that the over the entire time frame, the mutual fund might have done, again, closer to index returns, or even maybe even if they outperformed it slightly, but because they were looking at we call it dollar weighted returns, that there was fewer investors getting that excess performance, and then more investors and more investor dollars in the time period that had the slight underperformance. And we do see this pretty consistently. And Dalbar was the first one to quantify that. I think that's why I also saw that 3% gap between investor returns and investment returns. And does that kind of line up with what you've seen as well?
Yeah, so you're right in that the Dalbar study has had some criticism, and part of it has been placed on the methodology that was used in the underlying study. And we did touch upon this also, the notion that it's tricky to do studies with financial data because a lot of the time you have just a historical data set and you can't rerun history again and again to see, different sets of outcomes. It's very hard to do that without a time machine. So with this particular study and the Dalbar numbers, it was based on one time period, the U.S. market, and in that particular sequence of returns that was used, it did look more favorable from this one perspective, where it could have been explained by something else. Like you said, it could have been explained by the fact that investors were averaging sensibly over this entire period. So I think that's why I think the Vanguard study, which didn't show as high of a behavioral gap, but still did show a behavioral gap, it might be a little bit more robust, because what it tried to do is not look, it looked over one time period, but it looked over different markets that aren't wholly correlated. So it provides that notion of commonality that I had mentioned a few episodes ago, where if you really want to test a thesis, you have to be a little more creative and see if that thesis holds in other areas, like other markets that are not similar. Now, it's true that many equity markets do behave the same. So it could be that those results showed similar behavioral gap numbers because of this, but they included other markets that are not necessarily highly correlated with the equity markets, like bond markets and municipals and other types of instruments that are supposed to have a lower correlation. Yet this behavioral gap still showed, although again not at the Dalbar levels, but it was still there with a good amount of significance.
Yeah,
and the fact that
go ahead.
Yep.
Go ahead.
Just one last point. The fact that the behavioral gap did show a higher gap for the more exotic a market also adds a little bit more credence to the notion that there could be something more behavioral going on here. Again, we just have to use all this with a grain of salt. Nothing is perfect, but it can maybe provide us with a tinge of insight beyond just randomly guessing or theorizing.
Yeah, I think you almost have to know just a little bit of history of financial services to really understand these types of studies. Kind of breaking down the Dalbar study that came out around 2010, 2011. I looked at the previous 20 years, so approximately 1990 to 2010. Part of the problem is that go older than 1990, mutual funds just weren't quite popular yet. Like they just weren't being used as much. They were starting to emerge and people were starting to use them, but it was still the 80s was a lot of stockbrokers, and you might have a diversified portfolio that your stockbroker is recommending of 20 or 30 stocks that they're going to follow, and they'll call you up and say, hey, this one stock I've been following when it's been lagging a little bit, so I'm going to sell that one and buy this new stock. And that was most of financial services industry, especially in the 80s. And so it's when we look at mutual fund, like they kind of giving some benefit of the doubt to the Dalbar study. It's like it wouldn't necessarily make sense to look at mutual fund flows older than that because they weren't quite popularly in use. So if we like whatever time frame they pick, they tried to pick a time that mutual funds started becoming more in use, but they were subject, like you said, there weren't multiple histories that they can look at. It was just we started our study in the 90s. The 90s was a great year for all investments. And then the second half of our study was the aughts, the 2000 to 2010. I think that's the aughts, right? Is that...
Yeah.
Okay.
Yep.
Was actually pretty flat between the two crashes that occurred. That decade was kind of flat. And so that fund flows we talked about in my example of lots of people putting money in after the kind of growth in the 90s and the flat aughts was actually just people saving money. They didn't have as much money in 1990. They were just consistently earning income, saving more, and putting more in each year over time. And so what looked like more dollars going in the kind of from 2000 to 2010. So it looks like there's fund flows of money going in to investments chasing those returns from the 90s. It's actually just people saving and investing appropriately. It's just like you said, like that dollar cost averaging. They're saving into 401ks, they're saving into IRAs, they're saving into taxable investment accounts. And as they earn more money, they keep putting more money in, but more money went in the second half of the decade. And that's like when we look at these methodologies, it's almost important to understand, you have to actually understand what time-weighted return versus dollar-weighted return really means, because that's another way to think about investment return versus investor return. Because kind of super simplify an example, if an investment, we're going to give it a 100% return in year one, so it doubles in value and then stays flat from year 1 to year 10. Okay, so over a 10-year period, we double the value. We'll average, let's say we average 7.2% per year, our rule of 72. So our investment doubled. But if you were putting in $100 each year, your first 100 doubled, so it went from 100 to 200, but the other $900 you put in stayed flat. There was no growth on that. So your $1,000 that you put in, $100 each year over 10 years, has grown to $1,100. So while the investment return has doubled, your participation only saw your $1,000 go to $1,100. You only got a 10% rate of return instead of a 100% rate of return. But if we flip that sequence where it stays flat for the first 9 years and you get no growth on your $100 each year, but then you put in your last $100 in year 10 and then you get the 100% rate of return, now your $1,000 has doubled to $2,000. So now you've actually outperformed that investments. I guess you have exactly matched it, I think, if I get it correctly. But that's just an extreme example of illustrating the difference between that time-weighted return versus the dollar-weighted return. And that was kind of the biggest criticism, and deservedly so, of Dalbar, is that it was likely overstating the difference in investment return versus investor return simply because of the sequence of returns that actually occurred in the 90s versus the aughts. And that's why I say I think what you're talking about is the Vanguard study tried to do a better job of acknowledging that sequence and almost accounting for that sequence a little bit better.
Yeah, and you highlight another big thing, and it's a notion that there have been, in fact, secular changes in the market, and in terms of just how people invest in general, the proliferation of index funds from, broker generated custom portfolios of stocks, the the transition from actively managed funds to low cost ETFs. A lot of these things that were different, back 10, 20 years ago when some of this, seminal research started to come out, has changed in terms of just how the industry operates. One of the one paper that does come up from time to time, also related to this notion, is it was some research that was done by Barber and Odin. We had mentioned some of their work way back, but these were two academics who put together research based upon investor behavior, and the metric they were looking at was the relationship between turnover and so how often were individuals trading and how did that correlate with their end return that they ended up getting. So in the study, so that this actually came out, quite some time ago, the data was from the 90s, and what they noticed, just in terms of the punchline, is that over that period, the market had returned about 17%. Yet the investors who had a very high degree of turnover, after you account for all of their expenses, their net return dropped from around 17 to around 11 or 12%. So they gave up about 5% a year over this period, which is quite significant. And the investors that had less turnover, they had a higher net return, and the investors that had the lowest amount of turnover, well, that they had very close to that market level of return. So the title of the paper was "Trading is Hazardous to Your Wealth." And what we have to understand based upon that is, that's true. Likely, if you are trading a lot, there could be two main factors though that are leading to this. One is the notion of you may be just jumping ship to the worst thing at the wrong time, meaning, oh, this one went up, let's jump, to that stock, and that stock just did very well, let's hop to that, and just always mistiming things. That could be part of it. But another thing to realize is this is the 90s, and it actually was quite expensive to run this type of strategy. You would be spending a lot of money in actual commissions to pull that off. So, these two things are important to understand in terms of factors that may be different today. As we know, trading today versus the 90s is far different. You can trade at very low cost now, maybe even close to zero cost. However, the one thing has not entirely changed, though, that's the impact of taxes. So this study didn't look at that, but there are other studies that have looked at the impact of taxes. In fact, we have even related some numbers on this podcast where if you are trading and you keep having to pay your short-term taxes because you're not holding any of your positions for a year or more, you're going to have a much higher hurdle to overcome. So that just kind of comes down to math. The fact that if you want to match the after-tax return of a buy and hold strategy, you need to outperform that buy and hold strategy by the amount of taxes you would pay above and beyond the buy and hold strategy. Mm-hmm. And that can be upwards of a few percent a year, depending on your tax situation. So that's something where I think even if the dynamics of the market have changed in terms of the fees, there could be still a behavioral gap when you consider after-tax total returns for a strategy where individuals are trading more often than they would with a buy and hold. And the reason I do mention that is investors who do trade, some of the statistics still point to the fact that investors like to turn over their portfolio once a year, which is right around that number of having to pay a good amount in short-term taxes.
That's interesting. I guess now I'm getting questioning the research kind of thing. I'm trying to think, why would investors be turning over a decent amount of their portfolio in the short term? I almost wonder if there's, instead of like, I doubt people are waiting 11 months to sell something. And like, you know what? I'm going to sell it a month before my tax rate would drop by 20%. I'm almost guessing, do we see more trading significantly shorter, like within weeks or months, or like closer to that, like almost day trading kind of thing. And so like the average holding period might be under, and it's not even a year, but like that might imply how much is going to be short term.
Right. Yeah. So some of this has actually been tracked. So there's, for example, a study based upon data from the New York Stock Exchange. And what they did is they looked at holding periods for the positions that went across this exchange. And on average, a stock is actually being held less and less frequent over time. If you go all the way back to that, they had data from the 1920s. So in terms of holding period, when the data first started up until like the 1960s, the holding periods were in fact a lot longer. Obviously, there wasn't E-Trade or
Yeah.
online terminals to hop on and buy and sell intraday and whatnot. But people were holding for years at a time. I'd say the average from 1930 to about the 1970s to the early 80s was about 3 to 4 years in terms of holding period. But with the advent of personal brokers and then discount brokers and so on, since the 80s up until now, the holding period around the early 90s was still over 2 years, but by the late 90s it had dropped to under a year. And this data just goes through 2016, but it's pretty much been less than 1 year since the last decade through 2016.
Okay. So yeah, there's probably, again, going back to like it's hard to track good studies, hard to get good studies long term with changing history of financial services. Because I also wonder like how many of these trades, like the New York Stock Exchange doesn't know if the trade is happening in a qualified account versus a taxable account. So because I don't care about short-term capital gains in my IRA or my 401k, and pensions don't have to worry about that either. So again, kind of, but the New York Stock Exchange wouldn't know that. So that's like, again, issue with like understanding methodology and where the flaws may be. So
Yeah,
I think kind of going back, kind of bigger picture, acknowledging where all these flaws could be, where do you think we can actually see quantifiable value of working with an advisor? And then maybe we'll get in after that, we'll get into kind of some of the softer intangible side.
right. So there's a handful of things that, may be more quantifiable. So there's some research to suggest that, these are the few things that if you're not doing it, and it's likely that if you're a retail investor, you may not be doing these types of things, that by doing it, you would get an edge. So, for example, one big thing is just switching over to a lower cost investment strategy. So, for example, average expense ratios for actively managed products, ETFs, mutual funds and whatnots, are like 70, 80 bips or 0.7 to 0.8% a year.
That's already lower than I expected. I
Right.
was gonna guess they're on the scale of still about 1 to 1.1%.
They are. What I was actually quoting is for the balance funds, like the
Oh, I see. Okay.
S&P like products. So
Okay.
yeah, if you add in some more exotic stuff and average it out, it would probably be higher. But so there's some research that by switching to a balanced ETF portfolio. So my target is closer to like 5 to 10 basis points, so roughly 80 to 90% less on a once you weight everything on a dollar basis. Now, in the Vanguard study, there's a Vanguard study that did this. Now, Vanguard is a low-cost ETF provider. So
Again, got to question the methodology, but go on.
yeah, yep, definitely important to question and kick the tires. But what they're saying is that they estimate that a typical value for a value add by making this switch would be about 34 basis points improvement.
Okay, so just going from higher expense ratios to lower expense ratios, you can get similar returns, similar risk return profile, implement similar asset allocation, and just that alone would save you 34 basis points.
Right. Yeah.
Okay. What are some other things that you see? Go ahead.
So another thing to think about is this notion of rebalancing. So this is a mathematically proven and empirically proven notion that if you do rebalance, you can get a slight edge versus not rebalancing. So, let's say you come up with your allocation of 60-40 and you let it ride, for a decade or two. Meaning if bonds have a great year, they have a great year. If stocks have a great year, they have a great year. And then whatever happens, happens. And the other option is, what if you just rebalance every year back to a 60-40? So mathematically, just using math and not actual market movements, if you have a positive drift, meaning if these instruments tend to go up over time, then what you would likely get is an incremental gain as long as they're not perfectly correlated. So stocks are not perfectly correlated to bond, and and stocks and bonds do tend to go up over time. So you would expect this incremental gain. And, empirically what they showed, again, grain of salt, this is also from Vanguard, but I have seen more academic papers that have shown gains along this level of magnitude, but that's around 0.2%, 0.26% a year, 26 bips a year improvement by doing this versus not doing this.
Okay, so there's a couple things I totally agree with the research, and I totally agree with the point. But with rebalancing, there's two things I need to point out. One, if you have your 60-40 portfolio, while yes, there will be years where your bonds outperform your stocks, but that's usually driven by the stocks going down significantly. It's rare that you'll see stocks go up and bonds outperform stocks on the upside. But it's the idea, it makes sense of when your stocks go down, you're using the bonds which did not go down or does not go down as much to buy more of the stocks. You're forcing a buy low by rebalancing. But most of the time, you're going to see your stocks go up, goes from 60-40 to 65-35. You rebalance, you sell some of your stocks, you're kind of selling your high, selling a little gain, and back to that 60-40. And so rebalancing on the upside can hurt your raw return because you're consistently selling the high growth thing and buying the conservative thing, but it improves your risk adjusted return. And that's one key thing to realize when it comes to a lot of these studies is sometimes they're looking at raw return, sometimes they're looking at risk adjusted return. Because just to get the maximum return you can, just pick the riskiest investment and wait long enough. Going all emerging markets or all small cap, given any time frame we've looked at over the past, that might end up being the thing that has the greatest raw return. You just buy the really risky thing at the beginning. You go for the plus 50s, negative 50s from year to year. You get a really wild ride, but it has the highest expected return over a 20-year period. And so that's why the rebalancing of 60-40, while it will help you, especially kind of just the common sense side, it forces the buy low, sell high. You're either selling high because the stocks are up and you're taking your gains, or stocks go down and you're buying more of them. But realistically, it's improving your risk adjusted return. And it's kind of whatever the lifestyle or need or other external factor that led you to choose the 60/40 portfolio, we don't want to take on too much risk. The rebalancing will help you maintain that and improve your risk-adjusted return. You can get the return you want with less risk through the rebalancing, or you can kind of maintain some level of risk and get a slightly better return. So that's one thing when it comes to rebalancing it at a 60/40 portfolio. It's really looking at that risk-adjusted return. But one thing you mentioned, this is getting a little esoteric in terms of the math of looking at asset classes that don't have perfect correlations. Anytime they trend upward, you can get an improved return by rebalancing. A really good example would be large cap growth and large cap value. Both of these being US large cap companies would have a very similar long-term risk return expectation that kind of given long time, like the economics are similar enough that we would expect the same return for the same risk we take on. But these don't always go up the same way. So you will see growth and value deviate sometimes, and one will outperform the other in the short term. And here, if you look at just isolating growth and value, or any kind of, you could do small cap value, small cap growth, maybe US large cap versus international developed. But the idea is that these are equity returns. You can actually improve your raw return within the equity side by rebalancing between these two asset classes that have similar long-term return expectation, but aren't perfectly correlated. Because we actually are taking advantage of when growth outperforms value. And so our what was 50/50 is now, say, 60% growth, 40% value. We're selling the growth, buying the value, and we'll expect a reversion to the mean because they have a similar long-term return expectation. When one outperforms the other over some time frame, we would expect the other to outperform over a following time frame. Now, again, it's trying to identify that time frame is almost impossible, but so that's why we don't know when it's going to happen. We'll just keep rebalancing every quarter, every year, and eventually we'll benefit from that. So that's why you can't necessarily make timing decisions per se, but rebalancing it between two asset classes that have a similar return expectation but aren't perfectly correlated can actually improve your raw return over what you would have had just buying the blend and holding on to it. Again, this is a little more of investing theory, a little more esoteric, but it's another way to kind of really quantify. I mean, they can actually go back and kind of test this, quantifying that value of rebalancing. One is the 60/40 is kind of risk-adjusted return, but even raw returns of those asset classes with similar return profiles that have that non-perfect correlation can help improve your return. So I think that's another way we get that like 26 basis points per year value, and value being benefit, not growth versus value.
Right. Yeah. So, just another thing that might make sense to do if one is not doing it. And the next thing is this notion of asset location. So this is a topic we've also mentioned maybe, once or twice over the course of these episodes. But the idea here is it's likely that you're going to have assets in a taxable account and you're going to have assets in a tax sheltered account, such as an IRA, 401k, Roth, and so on. And it's also understandable that it might make sense to place the assets that are likely to give off, or the investments that are likely to give off a higher tax burden in the tax sheltered accounts, because then you don't have to worry about that high tax burden as much. So what you might also want to do is then shift the investments that are tax efficient and move them into the taxable accounts. So the old way of kind of thinking about portfolios is you kind of mirror what's going on in your traditional IRA and do the same type of allocation in your Roth, and then do the same type of allocation in your taxable account and so on. And you just have different silos. But with an asset location strategy, what I do with my clients is we say, let's step back and look at the big picture. Let's move, these very tax inefficient assets that have great returns, but they're going to throw off lots of taxes. Let's put those, in the IRA. And let's take these very tax efficient assets, maybe the municipal bonds, which don't have a high tax burden, and let's put those in the taxable account and so on. So by doing this type of strategy where you're locating assets in various accounts based upon their tax efficiency measures, then you can get an incremental return. Now, according to this Vanguard study, they're saying that you could get probably up to like 75 basis points a year, 0.75%, on average by doing this type of strategy versus not doing it. Again, the caveat is we don't know exactly how much this will benefit, and it can vary widely across various situations, including the various sizes of the accounts and how long they're being held and so on. But it's a notion that, again, it just makes a little more just pure mathematical sense on why you would want to do that. You're going to be holding these assets, so why not disperse them based upon tax efficiency?
Yeah, and I think about this has been one area where I have tried to implement, and in practice, it has not shown to be as simple as that. One part is rebalancing. I am kind of choosing rebalancing over asset location. But the other is actually usually the time frame. For most of my clients, if we're using retirement accounts, because you can't access those realistically until age 59 and a half, that implies a longer time frame. And so we invest more aggressively, sometimes 100% equities in the retirement account, but we will plan or at least have the flexibility to access taxable accounts to support lifestyle sooner than that. And so the time frame and the asset allocation ends up being different between taxable accounts and non-qualified taxable accounts and qualified accounts, that usually ends up making the difference. Or like you said, sometimes just dollar values in the different accounts make the difference. And in practice, I almost tend to see clients as they get closer to financial independence or retirement, especially in their late 50s, early 60s, most of the money tends to be in one or the other. Most of the money tends to be in a taxable account, or most of the money tends to be in a qualified account. And it's usually just from however they grew their net worth. If they grew their net worth with real estate and taxable investments, they might have used IRAs. Maybe if they're self-employed, they may or may not have had a 401k or chosen not to use that. So they might have more money in a taxable account, or they inherited money from a parent who passed away that was more in a taxable account, or they've been working for most of their career, saving into the 401k really aggressively, and that's taking care of their retirement, and they don't have as much in a taxable account. And so kind of in practice, I've seen sometimes 90% of their assets are in either taxable or retirement accounts. And so the asset location just hasn't been kind of as worthwhile compared to asset allocation, time frame, rebalancing, and just actual client situation.
Yeah, those are good points. I think with the asset location, I try to keep three things in mind. One is it's certainly more complicated. So this is actually one of the things where you could probably, as an individual client, you could probably do the rebalancing You might be able to do, you could switch to a lower cost ETF program, but trying to do the location can get quite messy, frankly. There's a lot of moving parts. You got to keep track of various cost bases on your taxable accounts if you're going to be shifting things around and whatnot. And it can get a little hairy. So also, when a client looks at each of their accounts, they're not going to look the same. You're going to get one that might be up and one might be down. And, that's going to be a crazy phone call if the client doesn't really have a good understanding of what's going on there. And the other thing I'd like to keep in mind is, just given all these complexities, it's usually for a situation that makes sense for the client. Now, on the good side is, as an institutional manager or as advisor on an institutional platform, the better news is there is software these days that we're able to leverage that can make a lot of this easier. So, for example, when I set up an asset location strategy, the software understands, this is the weights that we want, and these are the tax efficiency values for each of the different positions that the client will be in. And here's the pecking order, and here's the cost basis for all of the taxable investments and so on. So the good news is it can help figure out some of these things that might be harder if you were trying to use a pen and paper or a slide rule. So there is, technology that can help pull this off, but it does come with the added complexity that we definitely want to make sure that all parties are aware of. But, also I like the fact that you mentioned, kind of the next thing on the list here. And, that's the notion that if you do have accounts spread across taxable and sheltered, then not only is there the ability to locate assets differently, but there's also the ability to pull out assets differently from taxable versus the tax advantage accounts. Meaning, if you have a more sensible spending strategy, that can also provide you with value. So that's something else that was also studied in this Vanguard research. The notion that, if you need $10,000 in a given year and you're retired, well, you could randomly pull it out from each account, equally. But if you're a little more thoughtful on how you pull out that money, you could actually save yourself a good amount by understanding the tax implications of these various accounts and using that to your advantage.
This is one thing I have done in practice pretty well. So there's two layers. One is, are we pulling money out of retirement account versus taxable account? And if they are no longer earning income, then we actually want to take some money out of taxable investment accounts, paying at those low tax rates, kind of like filling up the 10-12% tax bracket. Because if we don't, then IRAs just kind of and 401ks keep growing, and eventually it'll be hit with RMDs, and their tax rates will be much higher. So in those years, we do look for either pulling money out for sport lifestyle, maybe Roth conversions, sometimes gain harvesting. But yes, I do look at how much we pull from the retirement account, and then on the taxable side, let's pull the rest from the taxable side. Now, getting back to our past conversation about cost basis, we can start to look at which investments do we sell to generate the cash to support lifestyle. And now we can make an even more tax-informed decision. And if all they had was the taxable account, then selling, so it's usually got the bonds. So stocks have gone up, there's unrealized gain. The bonds would not have a gain because they're generating interest. That's how they generate their total return. So most of the time, if we're trying to sell an investment in a taxable account without incurring a capital gain or minimizing taxes, then we're going to likely sell the bonds. If all they have is taxable, that might imply that they're taking on more risk. We're holding on the stocks, selling the bonds. And so what was a 60-40 portfolio is now 65-35, 70-30. But when we have both a taxable investment account and the retirement account, we can take money out of the bonds in the taxable account and actually maybe take money out of the stocks in the retirement account, because which asset class we sell from doesn't matter in the retirement accounts. It's only money in, money out. So the client can get the money they need for their lifestyle in the most tax efficient way, but we've now kept their overall asset allocation, their overall risk profile still in line. So that's probably the best way I use the asset allocation. It's maybe not necessarily on the growth and accumulation side, but spending down, making sure that we're keeping our risk return profile, our overall asset allocation in line, but choosing where the money comes from, which account it comes from. Clients kind of the same amount hits their checking account, they get to spend it however they want, but they're still better off from an after tax perspective. That's a great way to kind of combine spending with the asset allocation idea.
Yeah, for sure. And according to the Vanguard research, the benefit for this one is actually one of the more significant things on our list. It's the notion that you might be able to get up to 110 bips or 1.1% a year by just being more thoughtful about this. Again, this doesn't apply to everybody, because if you're not spending down, then it's less of an issue. But nevertheless, there still may be things that you can do to proactively help you in the future, the Roth conversions and things like that. So, moving money from these accounts or placing money into these accounts, even if you're not spending down, is also, I think, part of the pie when we think about how to ensure that the money goes in the right buckets and comes out from the right buckets.
Yeah,
so,
it's
yep.
I even want to kind of, I'm thinking even next level of if this plays out, say from age 60 to age 70 or 72 when RMDs start, you might actually get the situation where your retirement account is almost all bonds and your taxable account is almost all stocks. And that's actually okay. That means that your RMDs are going to be less. And if you don't spend down your money throughout your lifetime, under current and old tax laws, all the stocks in the taxable account would get a step up in basis. But it looks as of right now that might be going away. So maybe it's only one benefit instead of layers upon layers of benefit.
Your mileage may vary.
Yes.
So the last two on the list, they're not easily quantifiable, but they do have a quantitative impact. So I guess what we'll say is the benefit is likely greater than zero.
Okay.
And the notion on these two is, well, the first is something we also have mentioned, the focus on total return versus just, income investing. So what I mean there is often you hear, like news articles on, how about getting into these high dividend paying stocks if you need income, dividends are the way to go and so on. And, what I try to say in response to these notions is what you really care about, frankly, is not the amount of income you get from your dividend, but the total amount of income you get, meaning the total amount of income you get from dividend, interest, and capital gains or appreciation, whether it's realized or unrealized. And the notion there is if you look at the total return, then those are the investments you want to think about. But also, let's go one step forward. You want to look at the after-tax total return. And, frankly, if you target something that just provides a dividend, well, if you don't need that money, then that dividend ends up getting reinvested. That's not necessarily better for you because you just now have a taxable event versus alternative where if it's providing a similar return, but in the form of appreciation, well, that taxable event is pushed off into the future. And then you get to decide, when you sell that amount that you need to spend rather than the company or the stock deciding for you in terms of giving you a dividend. So, this focus on total return is also, part of the study. And again, it's a little harder to quantify. So we'll just say you're better off with this level of understanding than without it.
Yeah, I would agree with that. It's almost not quite old fashioned per se, but it is the next generation in kind of retirement planning, where it used to be, oh, you use bonds and use the coupons from bonds support your lifestyle. Oh, but then inflation of the 70s hit, and so your bond coupons aren't good enough to support your lifestyle. So okay, now we're in the 80s. We'll use dividend paying stocks. Well, now we'll live off the dividends. But I think even in the last 20 years, by focusing on total return, kind of combination of income, dividends, interest, like investment real estate, like focusing on total return. And then you can also kind of control when you sell the stock. So if dividends and long-term capital gains are taxed at the same rates, which is not necessarily safe assumption, it has to be a qualified dividend. There's other rules there. But for our conversation, we'll say they are. You still, by focusing on the total return, you still get to decide when you realize the gain. Whereas with the dividend paying stock, you don't have that control. And it allows just a little more customization, just a little bit more understanding of your lifestyle and tax situation outside the investments. If you're going to have a high tax year, let's not add to that through your investments. Let's wait till the following year. Or if you know it's a low income year, let's accelerate a lot of the investment related taxes into that year. Let's fill up that 15% tax bracket and maybe even get 0% capital gains for some of it.
Right. Yeah. And so the last one on the list here is this notion of asset allocation. And again, it's not really quantified, but frankly, this might be the most important thing to get right out of all the things. Aaron, you've mentioned this many times, that research suggests that in terms of what actually impacts your final return, it's actually getting that allocation decision correct, beyond just deciding, now that you have the allocation, what to specifically invest in. So yeah, that allocation decision is something that if you're not doing this sensibly, it can cause a big issue. Now, two of the big issues right off the bat are the notion that either you should be taking a lot more risk, but you're way too conservative, meaning you will not likely meet your goals. And if you have a long enough time period, you would have a pretty high confidence of meeting your goals if you were allocated appropriately. So, that's the notion of you're under geared. But then, also obviously on the flip side is the one that you also hear and think about, and that's you're over geared. You're plowing into retirement, but you're still, running at, 10,000 RPMs. So the notion is the high level notion is most people, when they start gearing towards retirement, they start ratcheting down their risks. So, just having this type of glide path that aligns with your personal preferences is something that can make a pretty big impact. It's quite hard to quantify. I'm guessing that's why the Vanguard study didn't quantify it, but I personally think it's one of the most important things that should get focus if it's not getting focus.
Yeah, that idea, like choosing the right asset allocation. I almost agree that there's definitely value in working with an advisor, because even good defaults, well, they're good, they're not perfect. And I use example, like you talked about the target date funds. And again, if someone's invested in a target date fund in the retirement account, great. It's a really good default. If that's all you picked, you're going to be fine. But if you look at the Vanguard Target Retirement 2050 fund, so again, we're 30 years away from this, or in this case, 29 years away. If you're investing this in your 401k, you're not going to touch it for 30 years. It's currently 90% stocks, 10% bonds. And now it's kind of like they kind of have to design that glide path of starting 100% stocks, say 40 years in advance, to something like 50 or 60% stocks within 5 years of current income. And so you see the kind of a consistent glide path going down from that. But I recommend to clients that a 2050 fund in your 401k or IRA, if you're if you're still 30 years away, that's too conservative for you. If you're honestly not going to touch this money for 30 years, this should be all in stocks. And that might be where I can help a client get an extra 1% per year over the next 30 years is by just putting together a 100% equity portfolio instead of a target date fund. Now, realistically, we're not going to stay 100% equities up until the year they start taking money out, but we can apply a little bit of common sense in terms of that timing. Instead of that rules-based glide path of you have to reduce your equity allocation every single year, approximately 10 to 15 years before we'll start looking at it, before we think we might start taking money out, we'll start looking, okay, should we start to reduce the risk? So I'm going to say about 10 years out might be the conversation of should we start moving from an 80-20, from 100% stocks to an 80-20 portfolio? And the idea is if it's happening right now, we've got a huge bull market over the last decade. Yes, let's make that change. Let's take the risk off the table. And if we happen to get a crash, we're not hurt as badly. But if it's 2009, 2010, and we just saw a huge downturn in the stocks, let's not sell the stocks after the crash. Let's not move from 100% equities to an 80-20 portfolio. Let's wait a couple years. It's okay to wait until we're 8 years out to switch from 100% stocks to an 80-20 portfolio. Now, again, might not recover that quickly. We don't know what time for us, but we can at least kind of apply common sense of not selling stocks immediately after they've crashed. And that's one thing where just kind of that almost common sense working with advisors in choosing the asset allocation can provide just a little bit extra that compounds over decades. But on the flip side, it's like you said, if it's money they might need sooner, they might actually be too aggressive, and we need to reduce that. And I think this is one thing I use kind of transition, like thinking about those intangible benefits of working with an advisor. One of my, again, a little more personal philosophies is actually I'm okay with really large cash balances, that we have a good, healthy cash reserve to make sure we take care of all the lifestyle stuff that could come up. And it also allows us to be a little more aggressive with the investments because we know we don't need it in the next 2 years, or design a asset allocation that aligns with time frame, et cetera. But we know we don't need to access the investments anytime soon. And so that healthy cash reserve almost doesn't get, I can't even think of how it could get factored into these types of studies. Other intangible is like clients using their investments to pay down their mortgage. And the math would say, if your rate of return can be greater than your interest rate, you can maximize your net worth by leaving the money invested and paying off the mortgage. But every time a client has done that, they've expressed almost like thanks that I spent my own money to pay down that mortgage, to pay down my mortgage. They all just genuinely feel better. And that's a kind of one of those intangible benefits. Clients asking, like, they had an IPO, can we buy a house with cash, or is that the stupid decision? And like, no, you'll set yourself, it's a more conservative decision because you might be giving up some net worth growth, but you won't have a rent or housing payment. So the money you need to support lifestyle is going to be easier to generate from that portfolio. You have more control. And these are some of those kind of those intangible benefits that are not net worth maximization strategies. Like from any quantifiable number, these would be considered inefficient ideas or costs or expenses that aren't improving their net worth or improving their assets, but genuinely make their lives better. They genuinely feel happier, they sleep better at night, and they appreciate that it's not going to be all just maximizing rate of return. And so I want to you can make it related to investments if you want, or related to net worth if you want. But when you think of other intangible benefits that your clients have received from working with you. What are some of your examples?
Yeah, it seems like on this side of the fence, we're likely talking more about the financial planning stuff. So a lot of the stuff we talked about earlier in this conversation related to handling the investment side of the equation. But there is a good amount of stuff that's more fuzzy, but it's on the planning side. It's on, how do I plan for retirement, and how do I get, uh, what can I retire? That's just a big question where having that understanding brings peace of mind. You can't quantify the benefit of that peace of mind, but it's it's certainly something that we do, and it's something that is likely appreciated from what we provide. And then you just kind of go through the list of the financial planning things that we can do, whether it's managing debt or figuring out a better way to deal with cash flow, or taking more advantage of just employee benefits. You mentioned a couple of goals, and making sure those goals are handled sensibly, making sure you're covered with your insurance. With insurance, there's one thing I like to say: having too much of the wrong insurance is just as bad as having too little of the right insurance. So just being able to balance your risks and understand where you should allocate your insurance dollars. Again, peace of mind. You may never need that insurance. You'll never know that benefit you're getting slowly year by year by having a sensible strategy over there. But it's something that, again, it's likely worth getting right, and it's why it's part of the services that typically come with a financial planner. And what I'd say the other main thing is having a financial planner in arm's length also has the ability, maybe not every day, week, month, maybe not every year, but every now and then, that there's likely a situation where having that planner lets you make a decision that you would not have made otherwise. And that can be pretty big in terms of cost, but again, it's just so hard to quantify. But making one misstep by making the wrong contribution, or missing a contribution, or having to restate something, or missing out on a match, and so on. So all these things, they may not show up all the time, but when they do get caught at the right time before they turn into a bigger mess, that they could certainly have a pretty big benefit.
I remember one of my first clients years ago, was contributing to a Roth IRA, and when they sign on, I look, it's like you actually, your household now makes too much money to contribute to a Roth IRA. We need to undo that Roth IRA contribution. We have to do a calculation called net attributable income, where we kind of calculate the growth on the Roth contribution and back that out. And luckily we caught this, I think I caught this like 6 months later. But if he hadn't hired me, he might have been doing that for years. And I see stories of that from other advisors, that those technically illegal Roth IRA contributions for years that have to get backed out. Yeah, it's like I said, it may not come up every month or even every year, but eventually having that person that you can talk to it's I'm trying to think, it's almost like the like a lottery ticket with expected value kind of thing. It's trying to think of a good analogy, where might cost you a little, like it's very possible that advisors fees cost a little bit more one year, cost more the next year, and then the year after that they save so much over your lifetime that it's kind of covered the fees for decades. I've seen that with loss harvesting strategies, which is another, like, I don't think the Vanguard studies touched on that, but that's another thing. Like, I remember in 2008, 2009, we were able to, for some clients, generate hundreds of thousands in losses because markets fell so much that they carried forward losses, and we saved them taxes for the next decade. It might only been on a scale of 7 to 9 years, but it's one of those things like doing all the work when it's available can save so much over the years. And I think you mentioned that question, like for someone who asks, "Can I retire?" I think sometimes even if the answer is no, the client still feels better because it changes an unknown into a known. It changes that like worrying about kind of like that unknown future anxiety and like I don't know what's going to happen into, okay, I know I'm not on track. Now I can take action. So it doesn't always have to be yes, you can retire, yes, you're on track. Sometimes even hearing a no, you have a lot of work to do, still provides those intangible peace of mind benefits.
Right. Yeah. And, I think a good analogy is just like insurance, right? You pay premiums, week and month after month, and then you're not expecting to make all of your money back instantly. But over time, when that bad thing happens, you get a windfall. Now, I do happen to think there still is incremental benefits along the way. We've listed a ton, at
Yeah.
the beginning of this conversation. So I think it's one of those cases where, yeah, you have those incremental benefits, and then it's also the bigger benefits that come, every so often. But I think I've seen it time and again with, client after client. So it's one of the things where it's not something that we say, up front, we're going to catch something in the next 3 years, that's going to pay for everything and then some. No, but it's something that, it having the ability to catch something and it happening so often, I feel like, that it is something that should be thought about when thinking about the value of an advisor.
I kind of chuckle at that. Like, okay, I can't promise I'm going to catch something that's going to save you 10 times my fee, but it's happened for every client so far.
Right. And the way I kind of think about it is, yeah, the financial planning stuff is a little more fuzzy, but you add that into the investment management stuff, which is a little more quantitative. Now that Dalbo study put the behavioral coaching at, the behavioral stuff at 3 to 4%. The Vanguard put that at, just a small fraction. The behavioral part out of the 7 we listed was maybe, 20%, 30% of the total. But, the other 6 or 7 things that we've added off get you back to that 3 to 4% range. And, maybe that is a bit more. They're saying, the Vanguard study is saying it's typical, but I think you add in the more fuzzy financial planning stuff, and then you add in, like we said, the windfall that might come every couple of years. I think the value does end up presenting itself over time.
Yeah. It's kind of, if you were playing, if you're flipping a coin where it's a 50-50 odds, but you'll get paid out kind of at even 110%, like your payout is plus 10% of your bet. Personally, I can imagine will kind of make pretty big bets, knowing that even if you lost 3 times in a row, you get that one big payoff. Like if the odds are in your favor, eventually you'll get that windfall.
Yeah, right. And like you've kind of alluded to, or what I've kind of seen is, I'm pretty sure every one of my clients, if we had started 10 years, before they joined, would have been quite better off, just having that relationship sooner rather than later.
That's another study that's a good question. Like, those who work with an advisor tend to have greater net worths than those who don't work with an advisor, even after controlling for things like age. But you have to question, like, is that just those with a greater net worth hire an advisor, and those who don't have the greater choose not to hire the advisor? Like, it's definitely questioning that result and the correlation causation aspect.
Yeah, I think for a lot of these things, it's going to be down to their individual situation. Often, when I do speak to a client, I start getting to know them. In my mind, I don't necessarily vocalize it, but I say, "Yep, I get up there, there, there. Oh,
Yeah.
that's a big one," and so on. And it does come out though sometimes where I am meeting with a client and there isn't really much that that I could bring to the table. Maybe it's a really simple situation. Maybe they're getting started. Maybe they've got a few things that I typically help other people under control, which is perfectly fine as well. So it's not to say that what the services that I bring to the table are universal for everybody. So I should certainly make that clear as well.
Yeah. Well, this was a fun conversation today. Thank you.
Yeah, thanks, Aaron. I enjoyed it as well. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.